The Federal Reserve has raised interest rates by 25 basis points, bringing the benchmark funds rate to a range of 4.75 to 5%. That is the highest level since 2007. Fed Chair Jerome Powell says that if the Fed needs to raise rates higher, it will, but the FOMC statement saw significant changes this month, with the phrase ongoing increases in reference to the policy rate now removed and replaced with some additional firming. And of course, this comes in the midst of ongoing concerns about the banking sector following the collapse of Silvergate, Silicon Valley Bank, and Signature. Fed Chair Powell also noted that yes, there are serious problems in a small number of banks, but assured the public that the Fed will use all of its tools to keep the banking system safe. Well, helping us make sense of this and what this all means for the markets and your portfolio and what the Fed could do going forward, let's bring in Danielle DiMartino Booth, the CEO of Quill Intelligence and author of Fed Up, an insider's take on why the Federal Reserve is bad for America. Well, Danielle, it's always good for America and for Kitco to have your insights, so welcome back.
Thank you for having me on this pretty historic Fed day, given we're in the middle of a banking crisis that nobody wants to call a banking crisis.
All right, well, that is certainly a big statement we need to unpack. Let's start off, though, Danielle, with your immediate reaction to this 25 basis point hike. Arguably, had there been no hike, that would have caused more panic. What do you make of that move?
So the Fed is pretty rigorous in terms of sticking to what market pricing is. And going into this, we were just about at 90% priced in for that 25 basis point hike. So to your point, Michelle, it would have upset the markets had they decided to pause, as so many politicians and bankers had been hoping that the Fed would. I think the real drama played out, however, in the press conference that followed, and clearly what the market perceived to be yet another Dr. Jekyll, Mr. Hyde performance from Chair Powell.
Yeah, in fact, that brings us to a clip I want to play, because we did see a shift in the language, as I mentioned, in the FOMC's post-meeting statement, saying, and I quote, "The committee will closely monitor incoming information and assess the implications for monetary policy. The committee anticipates that some additional policy firming may be necessary," so removing the more aggressive language there. But then in the press conference, we had a more hawkish Powell saying, if we need to raise rates higher, we will. Let's play this clip and get your thoughts.
If we need to raise rates higher, we will. I think for now, though, we as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Right. So, Danielle, if we need to raise rates, we will. Of course, a stark contrast from keeping at it until the job is done, and different from the messaging of the actual FOMC statement. What do you make of this?
So, Michelle, I think what's important is a little bit of background, a little bit of context. When the Federal Reserve meets for 2 days, it spends probably half that time choosing each word extremely carefully that goes. They can debate one word. Firming was probably debated for a good hour. I'm not exaggerating at all. You can read it in the transcripts. And I think that what the markets didn't quite understand initially was that the firming means that there's no chance that the Fed is contemplating slowing down or backing away from shrinking its balance sheet.
Okay.
And that is indeed a form of tightening in and of itself. In addition to that, a reporter asked Chair Powell if he had any intention of lowering interest rates in 2023, to which he said no. So whenever he goes off script, even if it's just one word, no, he does tend to shock the markets. And that is indeed what we saw. The clip that you just showed me was a bit unsettling as well, because Powell looks like he's not really comfortable in what he's saying. And that's a little bit concerning, again, because we're in the midst of a banking crisis.
Well, right. I mean, he did actually say that rate cuts are not in the base case. That was his response to that.
I mentioned with rate cuts, rate cuts are not in our base case. So that's all I have to say.
So there has been speculation that we would see a pivot in the second half of the year, perhaps even the final quarter. Given all of this information, and as you say, we are in the midst of a banking crisis, what do you see unfolding?
So I think that there was a complete get out of free jail sentence in the statement that basically got rid of forward guidance. It said that if developments were to come about, they would completely change the policy of their monetary stance. There was one sentence in the statement that basically said, if the world blows up, then we change everything and we change our approach. I think that that's what the market initially really celebrated, is that flexibility. And then we get to the press conference and Powell shows that he's really anything but flexible in the end, and really wants to continue with quantitative tightening and maintaining policy at a high level for longer than we were expecting. In fact, the dot plot, if you'll indulge me for 2 seconds, the dot plot for the end of 2024 was raised. The Fed funds target rate for the end of 2024 was raised from 4.1% to 4.3%. That tells me that they plan to maintain a higher for longer policy setting than what the market has even begun to contemplate, much less loosening in the second half of the year.
So you do think that the Fed will continue raising interest rates, even though we've been saying that they'll carry on until they break something? Arguably, we're starting to see that something break with the banking crisis, but they're going to compensate for that damage with the actions that we've been seeing from the FDIC. How does that raising rates, bringing down inflation while trying to preserve the banking system all factor into what you anticipate happening?
So obviously he's trying to thread a needle. In fact, it was very telling that he started the press conference by saying, first, I'm going to address what's happening in the banking sector, and then I'm going to talk about the economy, as if you can separate the two narratives and run them parallel to one another, which is rather insane. But he really is trying to maintain this parallel double narrative. And he thinks that because we haven't seen systemic risk, and he's right, we have seen breakage in the financial system, but we have not seen a break. We have not seen systemic risk where we see full-blown contagion. Banking regulators in Switzerland and the United States, they've been able to prevent a full-on global bank run at this point.
Well, are we going to see contagion? Can the banks handle these rate increases?
Well, I think the banks have made it clear that the regulatory mechanism needs to be relaxed in some way for them to be able to contend with these massive unrealized losses that they're sitting on, because we've got not one, not two, but three banks that have attempted to raise capital and failed, right? Silicon Valley was the first. It's fairly apparent with Fitch downgrading First Republic after the close again, one further notch into junk territory, that First Republic has also failed to raise capital, the third being PacWest today. We're also learning. Regulators don't want to say, they don't want to scream fire in a crowded theater. But the fact of the matter is, we're not seeing banks ride in like JP Morgan Chase did when it bought other banks during the financial crisis, like Bank of America did when it made the huge mistake of buying Countrywide during the financial crisis. And these are the days that come back to haunt the U.S. government, because banks have a long enough memory to not step in and buy these flailing banks. That's telling you something that you're not reading in the headlines, but nonetheless, these banks are sitting in a state of they're in no man's land, because nobody wants to say that they failed.
So is it likely then that we are going to see more bank failures?
I think we are going to see more bank failures. I think that because we have not seen the biggest banks step up. And in fact, yesterday, Jamie Dimon himself was in the headlines trying to quash the anxiety about First Republic. But I didn't wake up this morning to see any headlines announcing that JP Morgan Chase had purchased First Republic. And I don't think that's going to happen, or it already would have. at this point. And you saw with Signature Bank and it being bought that the purchase was predicated on the buyer being able to get rid of all the bad commercial real estate loans. That's not a full acquisition.
Right. So in the middle of this, I mean, the response from the FDIC has been to increase the insurance on deposits from $250,000 to, well, infinity, really. So de facto, deposit insurance covers all savings. And we saw that, as I mentioned, when the Fed, the FDIC, and the U.S. Treasury bailed out Silicon Valley and Signature deposits. So the topic of this came up in the press meeting afterwards. A reporter from The Economist was asking whether, it's now safe to assume that this applies to all banks. I just want to play this question and answer.
Sure.
And have you respond on the other side.
Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
All right, Danielle, I see you shaking your head there. Powell,
I'm shaking my head. Michelle, at the same exact time, blocks away in congressional testimony, Yellen was saying that all deposits are not covered. And I think that that's why right now the market's closed in such a state of confusion to have the chair of the Federal Reserve and the secretary of the U.S. Treasury at the same time at microphones broadcasting opposite messages. So there is clearly a large leadership vacuum in Washington, D.C. right now. Janet Yellen was probably never the right person for this job, but saving a bank that is important to the financial system, as you could argue, Silicon Valley Bank, the 16th largest in the country, you could argue that that was an important bank, but saving that bank and the bank that the reporter hypothetically cited as $1 billion in assets, those are two different things. And the implication was, well, we'll just let the small banks go. So there are no reassurances right now. I think that the FDIC, the Treasury, and the Fed and the administration need to get in a room and come up with a communication strategy.
So what would happen here? We've got the Fed raising rates. You're saying it's likely that this will cause at least one other bank to collapse. If the deposits of the people at that bank aren't insured above $250,000, and maybe if it's not the next bank, maybe it's the next bank after that. If we start to see that that doesn't apply, how does that chaos unravel?
Well, it would end up being somewhat chaotic because then you would think that you would have to go back and claw back Oprah Winfrey and Harry and Meghan's money that was 100% insured. Because the problem with coming in a very rapid fire way and backstopping all of the uninsured deposits at Silicon Valley Bank is the precedent has been set. It cannot be unset. And
right.
Therefore, as regulators, it's not your job to choose winners and losers, but that's the corner that they backed themselves into when they backed all of the deposits uninsured of Signature and SVB. And this is a bed that they've made. They're trying really hard to lie in it, and it's not pretty to watch.
Yeah, I mean, as you say, a precedent has been set. I guess some depositors' money is seen to be more valuable than others in the eyes of regulators, depending. And of course, there's been a lot of speculation that this may have to do with political affiliations and that those who got bailed out are aligned with the current administration. There has been speculation on that front as well. But now that you say this precedent has been set, you kind of have to maintain it.
You do. And I'm not even actually going to that. I actually think that it was less a matter of, gee, I'm in tight with the administration. I think it was much more a matter of, I don't know what I'm doing as a regulator. So I think it was more of a panic moment than anything else. And again, when you look at stories that have been written months and months ago that say, hey, we've got all these positions at Treasury that remain unfilled. at some point, you've got to have the ranks of people with sufficient experience in order to be capable of handling the situation that's unfolding right now.
And yet, Danielle, you do think that the Fed is going to continue raising, even in the midst of all of this?
I don't think that the Fed's going to continue raising rates necessarily.
Okay.
The Fed funds rate, according to the dot plot, is going to end the year at 5.1%. You could argue that there's another 25 basis point hike in there or not. That's completely irrelevant given how high interest rates are and the fact that the Fed intends to fully continue quantitative tightening in the background, which is its own form of tightening. You can equate it down to this many billions of dollars that rolls off the Fed's balance sheet is equivalent to this large of a rate hike on top of credit conditions tightening like a vice grip, whether you're talking about households, corporations, commercial real estate developers, you name it. We're hearing about lenders who are wholesale pulling out of auto loans or putting it on hold for 6 months. This is happening very, very real time. And that's why I think Powell was forced to acknowledge that a majority of the members on the Federal Open Market Committee raised concerns about tightening credit conditions and the effect that that could have on the real economy.
All right. Well, Danielle, as you say, there has been quantitative tightening. But then at the same time, from March 8th to March 11th, the Federal Reserve added $300 billion in assets to its balance sheet, which is a reversal from the previous trend of reducing the balance sheet since last summer. Now, you claimed in a recent tweet that this is because the discount window borrowing increased in addition to lending from the Fed's Bank Term Funding Program. And you say that this is not, in fact, inflationary. So explain that.
This is the opposite of inflationary. I wish that I could communicate this. There are different areas of the Fed balance sheet where liabilities lie. So if you're First Republic Bank and you're sitting on $30 billion of municipal bonds that don't qualify for the Fed's new facility, which only accepts treasuries and mortgage-backed securities, which is why there was only this $11.9 billion uptake to that facility out of the $298 billion growth in the Fed's balance sheet of its liabilities. But if you're in the unlucky enough position to be First Republic Bank and all you've got are municipals to bring to the discount window, not only does the Fed not loan you what the market value of that municipal bond portfolio is, they give you a haircut on it. So the bank actually has less money than what it had before, which is deflationary, because they have to be, the discount window by definition imposes a penalty on borrowers who are taking instruments other than treasuries and mortgage-backed securities to the discount window.
You said as well that contrary to how it may appear, the taxpayer is not picking up the tab here. Explain that.
To me, at least, the least happy banker in America is probably Jamie Dimon, because if you're being assessed a one-time fee from your homeowners association, they're going to resod all of the public areas. And if you're a homeowner in the homeowner association, then, if your house is 18,000 square feet compared to your next door neighbors, which is 1,000 square feet, then your one-time assessment's a lot bigger. So if the FDIC is going to be charging banks a one-time assessment based on their deposit base, when Jamie Dimon and Bank of America and Wells Fargo and Citi are being flooded with new deposits out of this flight for safety, that means your fine's bigger. That means your one-time assessment into the FDIC, your one-time insurance premium bump is going to be bigger the more you've got on deposit.
All right, well, very quickly, you did mention real estate, and some are pointing to commercial real estate, which is already being hurt by higher interest rates and empty office spaces as the next domino continues to fall here. And according to Axios, almost 70% of outstanding commercial real estate is in fact held by small and medium-sized banks. So small banks hold nearly 70% of commercial real estate loans. If we have more bank failures in the near future, what does this mean for commercial real estate loans? If they potentially default, how does this impact the real estate picture then?
So, Michelle, actually today I opened up my paywall and I published for the public an opus, and it's called Too Small to Not Fail. And I take a deep dive into small banks' exposure. Not only do they have less coverage for their deposits, their deposit coverage ratios are lower compared to medium and big banks. But as opposed to the great financial crisis, 2000, 2008, when they had 55% of their loans were commercial real estate, as you just noted, Kitco has cited, and I've got them all beautifully graphed out. They're 70% now. And that means that in a high interest rate environment, you're much more susceptible to having a community banking, small banking crisis nationwide. And that's my greatest concern. That's why I took the paywall down. And that's why I think we just about blew up the server at Substack, because everybody's been reading this piece all day long, which is my public plea on the part of the community banks that make up the backbone of the financial system that it appears Chair Yellen is willing to let go.
Well, what would that mean if they let those banks go and all of those loans default and all of those assets come crashing down? What does that even look like?
I have no idea. Looks like it. I have no idea. Looks like something terrible.
Yeah.
The small community banks should have never been stress tested when Dodd-Frank was first passed. That was highly inappropriate for a bank with $10 billion in assets to have to be stress tested. They reversed that law in 2019, but by then it was too late. They'd already made very risky commercial real estate loans to offset the increased cost of hiring pure overhead compliance officers to comply with Dodd-Frank.
Right.
So this is a regulatory backlash, the likes of which, Michelle, you got to read it. It'll explain everything, and it really is an outgrowth of Dodd-Frank and just policymaking gone very, very badly awry.
The Quill Substack. All right. Well, Danielle, we're here. Policy making has gone awry. We have a potential bigger banking crisis. We have the Fed continuing to tighten into what seems to be a recession, potentially stagflation, because we still have high inflation. Give me your economic outlook, broadly speaking.
So I'm not too terribly worried about price pressures at this juncture. You've just seen Amazon, of course, push through with a third round of layoffs, and the sheer number of business closures in the United States tells you that we're barreling our way very quickly towards an unemployment rate shock. So I'm not too terribly worried about inflation, but that's not a good thing. That's not a good thing because we're already in such a weakened state entering this deeper level of recession with household delinquency rates at the highest that they've been since the great financial crisis. I worry for households that have become highly overextended in this era of stimulus checks gone wild and credit card limits being raised and what have you. I worry about American families. I don't think we're prepared for what's to come.
All right. For the investor that wants to try and somehow prepare for what's to come.
Cash gold.
Cash gold.
Precious metals. At this juncture, look, there might be some municipals that become really cheap. Maybe interest rates fall on that. I don't know. But at this point, markets are on a day-to-day. It's as if they've got split personality syndrome. One day they're up 500 points, the last 2 days. Today they're down 500. They clearly don't have any certainty going forward. But what we can say about risky assets is that when you have credit standards clamping down like this, your credit tightening turns into an earnings recession in an ugly way and very fast.
Yeah.
And so valuations remain much higher than they have been this far into prior Fed hiking cycles. And I think investors should be positioned extremely defensively if they're in risky assets, or say, hey, the Fed just raised it by another 25 basis points today. I can get that much more on my cash.
So you're seeing a very big downturn ahead for the markets, broadly speaking.
I don't think that we're where valuations should reflect where this market's headed right now.
Final note, if you say cash gold, a lot of speculation that this is the year that gold hits a new all-time high. What does Danielle DiMartino Booth think?
Inflation or deflation, in times of financial crises, gold is the asset class that provides the most diversity and outperforms every other asset class, including cash.
Are you increasing your allocation to gold then in
Personally,
your portfolio?
Yes. Well, actually, that happened a little while ago, but I've been watching the fact that the discount window borrowing has been increasing since early 2022. So the stress in the banking system has been with us for some time now.
So beyond the traditional 5 to 10%, to what percentage?
Well, I think you can be
it's
bold.
different.
I think you can be bolder than that. All things. I mean, consult with your financial advisor. I don't provide blah, blah, blah.
Blah, blah, blah. Yes, everybody's different. I get it. But broadly speaking.
But this is a time that you can be bold in your allocation to precious metals. Of course it is. And keep the powder dry. You know, if there is major upheaval in a market, it's when everybody's afraid to get back in the water that it's really the best time to go swimming.
All right. Be bold in your precious metals allocation. I won't ask you how bold. I'm tempted to, though. How bold are you being?
I'm being as bold as I'm comfortable being.
All right, Danielle.
I sound like a politician now.
You do, actually. Well, fortune favors the bold is what I always like to say. Thank you so much, as always, for giving us your time and your very valuable insight. Danielle DiMartino Booth, appreciate it. Thank you.
Thank you, Michelle.
All right, and thank you for watching Kitco News. I'm Michelle Makori. As always, if you are catching this on YouTube, don't forget to subscribe. We'll see you soon.